The biggest banking system in history operates in complete darkness. On March 11, 2020, Reserve Primary Fund, a money market fund managing $125 billion in institutional assets, experienced a bank run that required Federal Reserve intervention to prevent complete collapse of the money market system. Within 48 hours, investors had withdrawn $60 billion from money market funds across the industry, creating liquidity pressures that threatened the $4.5 trillion money market sector and the broader shadow banking system it supports. But Reserve Primary Fund wasn't a bank. It wasn't regulated like a bank, didn't have FDIC insurance like a bank, and didn't maintain capital reserves like a bank. Yet its potential failure posed systemic risks, exceeding those created by most traditional banks because money market funds operate as critical infrastructure for the shadow banking system, a parallel financial universe that has grown larger than traditional banking while operating outside regulatory oversight that governs conventional financial institutions. The shadow banking system represents the most dangerous financial development since the creation of central banking because it recreates all the risks that caused the 1929 financial collapse while operating at scales that dwarf the economic conditions that created the Great Depression. Today's shadow banking system manages over $4 trillion in assets through institutions that provide banking services without banking regulations, creating systematic risks that make the 2008 financial crisis appear manageable by comparison. Understanding shadow banking requires recognizing that it represents systematic regulatory arbitrage, financial institutions providing traditional banking services while avoiding banking regulations through technical legal distinctions that eliminate regulatory oversight without eliminating systemic risks. Shadow banks take deposits, make loans, and create credit exactly like traditional banks, but they operate outside the regulatory framework designed to prevent banking system collapse. The mathematical foundation of shadow banking depends on the same fractional reserve mechanisms that created banking instability throughout history. But shadow banking institutions avoid the regulatory constraints that traditional banks must observe to prevent systematic breakdown. This creates mathematical conditions for banking system collapse without institutional safeguards that might prevent or limit such collapse. Money market funds represent the largest and most systemically important shadow banking institutions because they promise bank-like services to depositors while investing in commercial paper and short-term securities that become illiquid during stress periods. Money market funds collect deposits from individuals and institutions who expect immediate access to their funds, but they invest those deposits in assets that cannot be quickly liquidated during crisis periods. The mathematical structure of money market funds violates basic banking stability principles because they maintain minimal cash reserves while promising instant liquidity to depositors. When depositor demand for cash exceeds available liquid assets, money market funds face immediate insolvency that can trigger systematic banking runs across the entire shadow banking system. The 2008 Reserve Primary Fund collapse demonstrated shadow banking fragility when the fund invested in Lehman Brothers commercial paper that became worthless overnight. Depositor panic triggered withdrawal requests exceeding the fund's liquid assets, forcing the fund to break the buck, reducing share values below $1, which violated depositor expectations about money market fund safety and triggered panic across the entire money market industry. Federal Reserve intervention prevented broader money market collapse in 2008, but the intervention revealed that money market funds had become too systemically important to fail, despite operating outside regulatory frameworks designed to prevent banking system breakdown. The mathematical contradiction between systematic importance and regulatory absence creates conditions for financial system collapse that exceed anything experienced during traditional banking crises. Repo markets represent another critical shadow banking component that operates outside regulatory oversight while performing essential financial system functions. repo markets facilitate overnight lending between financial institutions through secured lending arrangements that appear safe but create systematic risks through massive scale and interconnectedness that extends across the entire financial system. The mathematical structure of repo markets depends on collateral values remaining stable, while borrowing volumes remain manageable relative to underlying asset liquidity. When collateral values decline or borrowing demands spike simultaneously across multiple institutions, repo markets can freeze completely, cutting off funding sources that numerous financial institutions depend on for daily operations. The 2019 repo market crisis demonstrated shadow banking fragility when overnight. Borrowing rates spiked from 2% to 10% within hours, as repo market demand exceeded available lending capacity. Federal Reserve intervention required hundreds of billions in emergency liquidity provision to prevent repo market breakdown that would have triggered systematic failures across institutions dependent on repo funding. The repo market crisis revealed mathematical impossibility of maintaining repo market stability when borrowing demand exceeds lending supply by margins that traditional market mechanisms cannot accommodate. Repo markets operate according to supply and demand relationships that break down rapidly when stress creates simultaneous borrowing pressure across multiple institutions seeking emergency funding. Hedge funds represent shadow banking institutions that create systematic risks through leverage levels and interconnectedness patterns that exceed traditional banking risks while operating without regulatory constraints that govern traditional financial institutions. Hedge funds borrow massive amounts relative to their capital while investing in complex derivatives that create unpredictable risk exposures. The mathematical leverage employed by hedge funds creates conditions where small market movements can trigger massive losses that require immediate deleveraging through asset sales that can overwhelm market liquidity and create systematic price breakdowns. Hedge fund deleveraging can trigger cascading failures across multiple asset classes simultaneously when multiple funds face similar pressures. Long-term capital management demonstrated hedge fund systematic risk in 1998 when the fund's collapse required coordinated intervention by major investment banks to prevent broader financial system breakdown. LTCM's mathematical models failed to account for correlation patterns during stress periods, creating losses that exceeded the fund's capital and threatened counterparty institutions throughout the financial system. Current hedge fund assets under management exceed $4 trillion, while average leverage ratios have increased substantially since the LTCM crisis, creating systematic risks that dwarf historical precedents. Modern hedge funds employ more sophisticated strategies across more asset classes with higher leverage, while maintaining interconnections that create systematic risks, exceeding what individual fund failures might suggest. Structured investment vehicles represent shadow banking institutions that issue short-term debt to finance long-term illiquid assets, creating maturity mismatches that guarantee funding crises when short-term debt markets become stressed. SIVs operate like banks, but avoid banking regulations by maintaining off-balance sheet status through technical accounting rules. The mathematical structure of SIVs creates systematic instability because they depend on continuous rollover of short-term debt to finance assets that cannot be quickly liquidated during stress periods. When debt markets become reluctant to provide short-term funding, SIVs face immediate liquidity crises that can trigger fire sales of underlying assets at prices that create losses throughout the financial system. The 2007 SIV crisis demonstrated systematic risks when multiple vehicles simultaneously lost access to short-term funding markets, forcing asset sales that overwhelmed market liquidity and contributed to broader financial system breakdown. SIV failures amplified mortgage market stress by forcing additional asset sales during periods when market demand had already disappeared. Exchange-traded funds represent contemporary shadow banking institutions that promise liquidity to shareholders while holding assets that become illiquid during stress periods. ETFs operate like mutual funds, but promise daily liquidity through secondary market trading that depends on market maker willingness to provide continuous buying and selling services. The mathematical structure of ETF liquidity creates systematic risks when underlying assets become illiquid, while ETF shareholders continue demanding liquidity through share sales. When market makers cannot obtain underlying assets to meet ETF redemption requests, ETF share prices can disconnect from underlying asset values, creating arbitrage opportunities that break down during stress periods. Corporate bond ETFs demonstrate this systematic risk by holding illiquid corporate bonds while promising daily share liquidity to investors. During stress periods, corporate bonds cannot be sold quickly at reasonable prices, but ETF shareholders expect immediate liquidity that cannot be provided through underlying asset sales. This creates mathematical impossibility that can trigger ETF breakdown when tested. Digital asset platforms represent emerging shadow banking institutions that provide banking services for cryptocurrency markets while operating outside regulatory frameworks that govern traditional financial institutions. Crypto platforms take deposits, provide lending services, and facilitate trading while avoiding banking regulations through claims that digital assets represent different asset classes. The mathematical risks created by crypto platforms exceed traditional shadow banking risks because digital assets lack underlying productive assets that provide value floors during stress periods. When crypto platforms face liquidity crises, underlying asset values can approach zero, creating total loss scenarios that exceed what traditional shadow banking failures might produce. The FTX collapse demonstrated crypto platform systematic risks when customer deposits were allegedly used for high-risk trading activities that created losses exceeding platform assets. Customer funds disappeared completely without insurance or regulatory protection that might limit losses during traditional banking failures. The collapse revealed that crypto platforms operate according to risk parameters that exceed anything in traditional banking. Private credit markets represent shadow banking growth that has occurred specifically to avoid banking regulations while providing traditional banking services to corporate borrowers. Private credit funds raise capital from institutional investors and lend directly to companies, avoiding regulatory oversight that applies to traditional bank lending activities. The mathematical structure of private credit creates systematic risks because funds cannot quickly liquidate loans during periods when institutional investors demand capital redemptions. Private credit funds promise liquidity to investors while holding illiquid loans that cannot be sold during stress periods, creating maturity mismatches that guarantee funding crises during market stress. Private credit assets under management have grown from $200 billion over $1.5 trillion since 2008, creating systematic risks through rapid growth in unregulated lending activities. Private credit funds provide financing for leveraged buyouts and distressed companies, while avoiding regulatory constraints that prevent traditional banks from excessive risk-taking. The regulatory invisibility of shadow banking represents deliberate policy choice by regulators who recognize shadow banking systematic importance, but avoid imposing regulations that might constrain financial system credit creation. Regulators understand that shadow banking regulation might reduce overall credit availability while transferring systematic risks to traditional banking institutions. This regulatory tolerance creates mathematical conditions for systematic financial breakdown, because shadow banking institutions operate according to the same risk parameters that created historical banking crises, while growing to scales that exceed historical precedents. Shadow banking recreates 1920s banking risks on scales that dwarf 1920s economic conditions. The 1920s banking system operated with minimal regulatory oversight while employing leverage levels and interconnectedness patterns that created conditions for the 1929 banking collapse and subsequent Great Depression. Modern shadow banking employs similar risk parameters while managing assets that exceed 1920s economic scale by factors that make potential breakdown consequences unpredictable. Federal Reserve shadow banking oversight operates through indirect mechanisms because shadow banking institutions technically avoid direct regulatory jurisdiction while creating systematic risks that require central bank intervention during crisis periods. The Fed can provide emergency liquidity to shadow banking institutions, but cannot prevent risk-taking activities that create systematic breakdown conditions. This regulatory asymmetry creates moral hazard where shadow banking institutions can engage in excessive risk-taking while expecting Federal Reserve support during crisis periods. Shadow banking benefits from implicit government backing without regulatory constraints that might limit risk-taking activities, creating systematic incentives for excessive leverage and interconnectedness. The mathematical progression of shadow banking growth suggests approaching systematic crisis that will exceed 2008 financial breakdown because current shadow banking assets and interconnectedness exceed pre-2008 levels, while regulatory frameworks remain inadequate for systematic oversight. Shadow banking has grown faster than regulatory capacity while creating risks that traditional banking regulation cannot address. International shadow banking coordination creates additional systematic risks through cross-border interconnections that operate outside any comprehensive regulatory framework. European shadow banking, Asian shadow banking, and American shadow banking create global systematic risks through interconnections that no single regulatory authority can oversee effectively. The Archegos capital collapse demonstrated international shadow banking risks when the family office's failure affected banks across multiple countries while operating outside regulatory oversight in any jurisdiction. Archegos employed massive leverage through total return swaps while avoiding disclosure requirements that might have revealed systematic risks to counterparty banks. Current shadow banking mathematical relationships suggest systematic breakdown probability approaching certainty because asset growth, leverage levels, and interconnectedness have reached thresholds that historically preceded banking system collapse. Shadow banking operates according to mathematical principles that guarantee breakdown when stress reaches levels that test systematic liquidity and capital adequacy. Understanding shadow banking as systematic regulatory failure rather than market innovation provides insight into why financial crises consistently exceed regulatory expectations and intervention capabilities. Shadow banking recreates historical banking risks while operating at scales and interconnectedness levels that exceed regulatory frameworks designed for traditional banking oversight. The $4 trillion shadow banking system represents the largest unregulated banking system in history, operating according to risk parameters that created previous banking collapses while managing assets that exceed historical precedents by mathematical factors that make systematic breakdown consequences unpredictable. The system operates in darkness because light would reveal systematic risks that regulatory frameworks cannot address without fundamentally restructuring financial system architecture. Nobody talks about shadow banking because discussing it honestly would require acknowledging that the financial system operates according to risk parameters that guarantee systematic breakdown while growing to scales that exceed intervention capabilities. The darkness isn't accidental, it's necessary for maintaining confidence in systematic stability that mathematical analysis suggests cannot be maintained indefinitely. The mathematical inevitability of shadow banking breakdown operates independently of regulatory intentions or policy interventions because shadow banking has recreated historical banking fragility while growing beyond regulatory capacity for systematic oversight. The biggest banking system in history operates in complete darkness because light would reveal mathematical impossibilities that make systematic stability impossible to maintain through conventional regulatory mechanisms.